Welcome to the deep dive. Today we're tackling a really interesting hypothesis, one that's been floating around. Is the private equity sector, PE, basically acting like a giant unregulated bank, creating money almost invisibly?
That's the core question, yeah. And to get there, we first need to be crystal clear on the baseline. What is official money creation? How do regulated banks do it? Because PE operates, well, quite differently.
Right, so our mission today is to figure out, is PE actually creating new money like a bank, or is it more of a massive credit intermediary? And why does that difference matter for, the whole economy?
Exactly. That distinction is critical for understanding systemic risk.
Okay, so let's start with the banks. There's this kind of alchemy people talk about. The common idea is banks just lend out the money people deposit, right?
That's the popular myth, yeah.
Right.
But the reality under fractional reserve banking is different. When a regulated bank makes a loan, it actually creates a new deposit in the borrower's account. Poof, instant new money.
Yes, like that, with a few keystrokes.
Pretty much. That's the money multiplier effect in action. It expands the total money supply.
Wow. Okay, but that power sounds huge. It must be tightly controlled.
Oh, absolutely. That's where the strict regulatory perimeter comes in. Think Basel Accords, capital requirements, liquidity rules. Banks face really rigorous oversight.
Uh-huh.
These rules act as guardrails, specifically designed to limit how much money, and therefore how much risk, banks can actually create.
Got it. So that's the regulated world. Now, shift gears to private equity. The engine seems to be the leveraged buyout, the LBO. How does that work and how has it changed?
Right. The LBO is classic PE. Basically, buying a company using a ton of borrowed money sometimes, like 80 or even 90% debt. And they use the company's own assets as collateral for those loans.
Okay, high leverage, but who's lending all this money now? You mentioned a change.
Exactly. Post-2008 financial crisis, new rules like Basel III made it more expensive, riskier for traditional banks to hold these highly leveraged loans on their books.
So banks pulled back.
They did, somewhat. And into that gap stepped private credit funds. Often these are actually run by the very same firms doing the PE deals.
Oh, interesting.
Yeah. And now these private credit funds finance something like over 3/4 of all LBOs. So the debt and the risk has largely moved outside that regulated banking system we just talked about.
Okay, so here's the crux of it, the big bank theory. PE is driving this huge amount of credit, massive deals, but it's not a regulated bank. So how is its process different? Is it creating money or not?
This is the key technical point, the aha
Yeah.
moment, really. When a regulated bank lends, like we said, it creates a brand new deposit, new money.
Right.
But when a private credit fund lends for an LBO, it works differently.
Yeah.
It issues what's called a capital call to its investors. Think big pension funds, endowments, sovereign wealth
A
funds.
capital call, what does that mean?
It means the investor has to send money they already committed. So the private credit fund tells the pension fund, okay, send us that $1 million you promised. The pension fund then transfers existing bank deposits from its bank account to the borrower's bank account via the fund.
Ah, so no new deposit is created overall. It's just moving existing money from the investor's account to the company being bought.
Precisely. The total amount of deposits in the banking system doesn't change. PE expands credit. It creates new loans, new financial assets and liabilities, but it doesn't expand the actual money supply, the M1 or M2 the central banks track.
So it's acting like a super efficient, maybe supersized credit intermediary, not a money creator.
You got it. It speeds up the velocity of existing money, channeling it into these big deals, but it's not adding to the base money stock itself.
Okay, but even if it's not technically money, this system is enormous. You hear about dry powder. Why is that specific pool of capital considered potentially risky or invisible?
Right? Dry powder. That's the trillions, literally trillions of dollars that investors have committed to PE and private credit funds. But the funds haven't called it up or spent it yet.
Trillions waiting on the sideline.
Exactly. It represents this massive latent demand for credit, specifically for LBO debt, like a shadow credit pipeline ready to go. And a key issue is that it's largely policy insensitive.
What do you mean by policy insensitive?
Well, think about it. The central bank might raise interest rates sharply, trying to cool down the economy and slow down bank lending.
Yeah, standard monetary policy.
But that dry powder, that capital was committed by investors maybe years ago under different conditions. The PE firms can just make the capital calls and deploy those trillions into deals regardless of current interest rates.
So PE activity, fueled by dry powder, could potentially keep booming even when the central bank is hitting the brakes, undermining monetary policy.
That's the concern, yes. It can unleash waves of M&A and credit creation that run counter to what policymakers are trying to achieve. So the theory that PE is this huge, opaque, highly leveraged credit system, that's spot on.
Okay.
The real risk isn't so much that we've mismeasured M2, the money supply. It's the sheer scale of this unregulated leverage and the deep interconnectedness. If things turn sour, if defaults rise in private credit, the stress could spread incredibly rapidly through the financial system, precisely because it's outside those traditional bank regulations.
Right. So maybe this is the final thought for you, the listener, to chew on. Given the absolutely massive scale of this private equity and credit complex, does that technical distinction that it's not creating official money really matter if the economic impact, this huge policy-resistant wave of credit, feels practically the same?